Japanese candlestick patterns. A brief history of Japanese candlestick charting patterns. Candlestick charts originated in Japan during the 18th century. Since no defined currency standard existed in Japan during this time, rice represented a medium of exchange. Various feudal lords deposited rice in warehouses in Osaka and would then sell or trade the coupon receipts, thus rice became the first futures market. In the 1700s, legendary Japanese rice trader Hama Munehisa studied all aspects of rice trading from the fundamentals to market psychology. Hama subsequently dominated the Japanese rice markets and built a huge fortune. His trading techniques and principles eventually evolved into the candlestick methodology, which was then used by Japanese technical analysts when the Japanese stock market began in the 1870s. The method was picked up by famed market technician Charles Dow around 1900 and remains arguably the most popular form of technical analysis. Why use candlestick charts? Today's traders candlestick charts show the same information as bar charts, but in a graphical format that provides a more detailed and accurate representation of price action. Candlestick charts visually display the supply and demand situation by showing who is winning the battle between the bulls and the bears. Candlestick charts reveal another dimension of the given period's price action by pictorially displaying the force, or lack of force, behind each price bar's movement. Candlestick formations make all single bar and multi-bar patterns significantly easier to spot in real time, thus increasing your chances of catching high probability trade setups. In addition, because candlestick charts use the same data as bar charts, open, high, low, and close, all Western technical signals used on a bar chart can easily be applied to a candlestick chart. Candlestick charts offer everything bar charts do and more. Using them is a win-win situation, because you can use all the trading signals normally used on bar charts, with the added clarity and additional signals generated by candlesticks. Candlestick charts are more fun to look at. The anatomy of a candlesticks have a central portion that displays the price distance between the open and the close. This area is known as the real body or simply the body. The price distance between the open and the high for the period being analyzed is called the upper shadow, sometimes referred to as an upper wick as well. The highest price paid for a particular period is marked by the high of the upper shadow. The price distance between the close and the low for the period being analyzed is called the lower shadow, sometimes referred to as a lower wick. The real body displays the opening and closing price of the security being traded. Closing prices have added significance because they determine the conviction of the bulls or bears. If the security closed higher than it opened, the real body is white or unfilled, with the opening price at the bottom of the real body and the closing price at the top. If the security closed lower than it opened, the real body is black, with the opening price at the top and the closing price at the bottom. Depending on the price action for the period being analyzed, a candlestick might not have a body or wick. To better highlight or visualize price movements, modern candlestick charts, especially those displayed digitally, often replace the black or white of the candlestick real candlestick body. Patterns colors there are multiple forms of candlestick patterns, and here is a brief overview of the most popular and widely used single and multi-bar patterns commonly used. Bullish candle signals uptrend movement. They occur in different lengths. The longer the body, the more significant the price increase. Bearish candle signals downtrend movement. They occur in different lengths. The longer the body, the more significant the price decrease.
Reversal patterns are chart formations represented by a group of candles that help us identify high and low points. For example, when we buy a stock, we want to sell as close as possible to its high. But if we are shorting a stock, we want to buy it back as close as possible to its low, just at the point where it begins to go up. Reversal patterns are usually formed after a significant rise or fall in price. They are subdivided into bullish, implying an upward direction, or bearish, implying a downward direction, formations. The following reversal patterns are common and accepted by professional traders. Doji, a bullish pattern formed at the base of movement, when after several downtrending candles, a candle appears showing that the open and closing prices are identical. A doji usually indicates possible pattern reversal. Dragonfly doji, a bullish pattern created at the base of movement, similar to the doji, but with the addition of a wide-range bottoming tail indicating that control has been taken by buyers. Gravestone doji, a bearish pattern created at the peak of movement, similar to the doji, but with the addition of a wide-range topping tail indicating that control has been taken by sellers. Dark cloud cover, a bearish pattern in which the black candle covers more than half of the clear candle's movement in the opposite direction of the stock's overall movement. Engulfing, a bullish pattern in which the clear candle covers more than the entire length of the black candle in the opposite direction of the stock's overall trend. Evening doji star, a bearish pattern in which the doji heading the trend indicates pattern reversal, and the black candle following it falls at least halfway below the body of the clear candle preceding the doji. Evening star, a bearish pattern At the trend's peak is a narrow range candle indicating pattern reversal. The black candle following it falls at least halfway below the body of the clear candle that precedes the narrow range candle. Morning doji star, a bullish pattern opposite to that of the evening doji star. Here the doji indicates pattern reversal after the black candle. The clear candle following the doji rises at least halfway above the body of the black candle preceding the doji. Morning star, a bullish pattern opposite to that of the evening star. At its base is a narrow range candle indicating pattern reversal, followed by a clear candle rising at least halfway above the body of the black candle preceding the narrow range candle. Long lower shadow, a bullish pattern. At its base is a candle with a long bottoming tail, followed by a clear candle rising to at least halfway above the body of the black candle preceding the bottoming tail candle. Long upper shadow, a bearish pattern. Its movement peaks with a candle having a long topping tail, followed by a black candle dropping at least halfway below the body of the clear candle preceding the topping tail candle. Piercing line, a bullish pattern. After a black wide range candle, a clear candle follows and penetrates beyond the halfway point of the black candle's body. Hammer, a bullish pattern, formed with a short-term downtrend in which the price of a stock drops significantly but recovers during the candle's time interval and closes with a significantly higher price than the low price. Hanging man, a bearish pattern, formed within a short-term uptrend in which the stock price drops at the start of the candle's time interval but recovers and closes with a high price. The strong sales at the outset indicate the beginning of the end for buyer control. Inverted hammer, a bullish pattern, created when dropping stock reverses its pattern briefly and rises, but returns to the bottom at the end of the candle's time interval, leaving a topping tail. The strong buying pressure at the outset indicates the beginning of the end of seller control. Spinning top, a bearish pattern. At the pattern's peak is a narrow range candle with two tails, followed by a black candle that falls at least halfway below the body of the clear candle preceding the narrow range candle. However, there is little point in learning patterns if you do not know when to press the buy or short button.
In the next lesson, we will talk about risk management in day trading and risk management in long-term trades and swing trades as well.